Hey everyone, it's Josh Brown. I'm live from the compound with my friend Tony Dwyer of dwyerstrategy.com. Tony is a legendary Wall Street strategist. Am I overplaying that?
Legendary.
Or it's just right?
It's a stretch, dude.
All right. Well, in my mind, a legendary Wall Street strategist. So we're going to talk about a few things today, but the main thing I wanted to make sure we got to was just what you think is going on right now. And I'll just kind of set the scene. It's been an incredible year-to-date performance for the stock market after a tough fourth quarter last year. The recession calls seem to have gone away. The Fed seems to have receded into the background. People aren't really talking about it as much. So now we're kind of like, okay, will there be earnings growth? Will it justify the current stock market valuation? And then all the political stuff seems not to matter at all unless it's related to trade. I mean, am I pretty much summing up what's happening?
Yeah, I think that's right. Josh, what was really amazing to me, so I never thought we'd get a 20% drop like we got. I think it was a market event that happened. So let's
Right.
put that up front. I was wrong. I didn't think it would be that big. In early October, on the show I went out with that we do together, I went out with a correction call because Fed Chair Powell scared the hell out of me.
Right.
Every recession of the last 7 recessions has been preceded by a shutdown in credit, which means you and I can't get credit, our businesses can't get credit, it just shuts down.
Right.
That is caused by when short-term interest rates go above long-term interest rates, which is an inversion of the yield curve.
That's the yield curve inversion that everyone's been talking about.
Correct.
And it looked like they were hell-bent on taking us there.
Yeah, and so what he said that scared me
Right.
was the quantitative easing and the expansion of the balance sheet may mean that the yield curve inversion doesn't matter because you're artificially suppressing the long end of the curve. So in English, what that means is, I'm going to do it again and not care. It's exactly what Greenspan did.
Yeah.
When he said Japanese buying in the 90s was artificially suppressing the long end. It's exactly what Bernanke did in 2005 when he said the long end is being suppressed by Chinese buying. There's always an excuse for shutting down.
There's always a reason for why the long end is doubting the long-term view of the economy.
And that's what drives me bananas,
Right.
because people try to look at it. It's always different this time. There's always a reason. Banks don't care why the curve inverts. It doesn't matter.
So this time, what is it? It's weakness in Europe and China? And
No, it's quantitative. The Fed buying the balance sheet and weakness overseas, to your point,
Right.
is making too many buyers for the long end of the bond market, so it's artificially suppressing it. But all of that's really nice, and it's great, jargon for us to play with.
Right.
What it comes down to is a bank or a shadow bank is not going to lend money to lose money. They're not going to lend money to you at 3% if they've got to pay 3.5% for the money. Right? So bottom line is, that's what shuts down credit, that shuts down the market. So that's what scares me in October. What really excited me yesterday, even after the 18% run, and we've been thinking we were going to have this a bounce, was that he said in his prepared testimony, the Fed chairman said that the actions that they've taken have had an effect.
Right.
It's an amazing statement because basically what he just said is, I'm not going to invert the curve.
Right. And then you combine that with the minutes. The Federal Open Mouth Committee is basically using the word patient or patience multiple times, like 15 times or whatever it is.
Yeah.
So, all right. So for people watching this that aren't following the economy and the stock market tick by tick, what are the most important things to you? You've been watching this forever, your whole career. What do you think are the things that people should focus the most on? Not to predict what's going to happen, but just to have a sense of what's happening now.
Josh, there's 3 things that are great signs of a recession's coming. Ultimately, the only thing you have to determine, and I'm kind of considered a permabull because for 10 years, the yield curve hasn't inverted and credit's been okay. Right? So what you have to really...
why aren't you bearish yet? Let me know when short rates cross over long-term rates,
That's
and then
it.
maybe I'll have a reset. That's basically what
That's
you're saying.
it. And also, there's something called the ISM Manufacturing Survey where they go out and survey manufacturers around the country and say, how do you feel?
Yeah.
From the date that peaks in a cycle, you typically have 3 years before you go into a recession. When you have NFIB, which is the Small Business Confidence Index, and small business drives our country, that peaked in August as well. It's almost 4 years between a peak and that.
How do you know it's a peak? In real time.
Yeah, I'm just making an assumption because it was at such a new high, historic high.
Right.
I don't even have to make the case it's a peak. Let's just assume it is. We still got 3 to 4 years.
Okay.
So you've got 3 indicators that are telling you between the inversion of the yield curve leading a recession, or the ISM manufacturing, or the small business optimism, they lead by anywhere between 2 to 4 years. So when I hear people make comments that I'm expecting a recession before you've inverted the yield curve.
So you're like, based on what?
Based on what?
Yeah.
And that's where I think it's so important to differentiate.
Well, so you could have an out of nowhere recession, but it would have to be caused by something exogenous that's not market related, that no one could foresee by definition.
I don't think you can, because you never have. Let's talk about
an asteroid takes out Denver.
Exactly. And at that point, people say that to me. Okay, you're going to get it. At that point, if you have a recession without a shutdown of credit, something so significant has happened that my opinion is not relevant, nor is your money.
All right. So you're following those things, and it's not that you're saying, oh, GDP is going to be stronger or weaker. It's just that you're saying, okay, what is the emergency? What is the rush to call for a recession?
Exactly.
Okay.
So what does that mean?
That just seems rational. I'm not like a forecasting guy, but that just seems rational to say the preconditions for every recession have not taken place yet.
So what makes you want to?
What are we guessing based on?
What makes you want to get negative or cautious near term? First of all, I will never, and I've said this to you directly and on the show, I will never, ever, ever be bearish until you shut down credit, because every pullback is temporary. It proved to be true again this time, although it was an awful, historic, non-recession crash kind of drop.
Right.
We got it back in 2 months.
Right.
So all corrections are temporary, really, anyway, but until you go have the prospect of a recession. And there's no way, you haven't been able to predict that without an inversion of the yield curve for the last 70 years. So why are you going to do it today?
Now, for our younger viewers or people who aren't as experienced as investors, the whole concept of recession is actually ironic for investment guys to be talking about, because by the time it's definitive that you're in one, you're pretty much halfway out of it.
Your game's already, you want to be a buyer.
So even if you know it's a recession definitively, it probably should make you bullish, if anything at all.
100%.
Right. So I think that like when new investors hear recession, they might have this idea that, ooh, maybe I should not be investing. You actually should be investing even more.
Yeah.
If you have 30 or 40 years of investing.
Well, frankly, if you're young, you shouldn't worry about anything, and you should just,
Right.
Actually, let's play crazy and just be an investor and not a trader. We all want to pretend we're smart and think we're great.
Right.
Ultimately, a young person should just be buying stocks because it's the best performing asset class, and you can play international if you want, or domestic. Ultimately, it's the target date fund stuff.
Yeah.
A lot of the listeners and viewers are going to know that they're in target date funds that are based on their age. If you're under 40, that means you're already 100% long only.
Yeah.
Equities. So.
And the recession, as you're accumulating assets, is only going to help you.
So if you wanted to actually,
discount.
the thing that gets me to stop buying, let's say do you buy the next tick, is when you have the majority of people are optimistic about the market. I measure this through Investors Intelligence newsletter writers, right? What sells news, Josh? It's never the dad that's out there with his girls in the backyard pushing on a swing and having a great time at ballet. It's always the dad. It's the calamity. It's the dad that's shooting somebody, right? Yeah. That's what sells. So when you have 60% of newsletter writers on the stock market bullish, that violates the principle of what's selling their newsletter. Right. It's why some of the more negative newsletters are the biggest ones, right?
They should, right.
So when people get
they
too
should
bullish,
be negative. They're in that business.
That's
the
right.
Newsletters.
That's how you sell it. I mean, think about it this way. I'm kind of the village idiot when I'm in a room because I'm bullish. Right. It sounds so smart to be bearish. There's too much debt. There's too much this, the Fed, the Trump.
The bearish arguments will always sound more sophisticated.
Yeah.
And the bullish arguments will always sound goofy.
And I would rather be goofy, because ultimately, what makes the young people listening to this, or even the old people listening to this money, is the fact that as long as the Fed monitors monetary policy and makes it so that you and I and all the people watching and listening can get a loan, guess what? The game is on. I'll never forget, February 16. It looks like we're going into a recession. We're in an industrial recession. This is kind of a funny story. Right. I know the exact low date. It was my birthday, February 11th. Market's down about 600 points on the Dow. I'm in the middle of Chicago, stuck in front of a snowstorm, bitter on every angle. So I go into this meeting. I'm doing a lunch. I go into this lunch. There's a conference table full of people. they're there because it's free lunch, because market's tanking, right? So rather than go through my pitch deck, which I think is really good, but I'm biased.
And they've probably seen it.
Who cares? The market's down 600 and crashing, and it looks like we're in a recession.
You hear my slides.
Right, exactly. So what I did is, let's do this. I opened up on an open mic. I called my mortgage broker, and instead of going through my slide deck, I refinanced all my debt on the spot in 15 minutes.
No way.
I swear to God.
How many people were in the room?
There were probably 10 people in the room. Okay. And I looked at all of them and I said, guess what? Not in a recession. I just did that in 15 minutes.
Right. I love it. All right, guys, this has been Tony Dwyer, and you want people to check you out on dwyerstrategy.com?
Dwyerstrategy.com.
You're on Twitter? You're tweeting up a storm?
Yep, at Dwyer Strategy, and I love doing it. I love following you like everybody else on the planet.
All right.
So you guys have done a great job.
Stick around. We'll do more with Tony.